Hey folks, do I have an exciting video for you today? The Federal Reserve's own Jerome Powell recently spoke about the damage he is willing to cause to the economy to get inflation back to the nominal 2% rate by raising interest rates, knowing that it's going to cause housing issues, stock market issues, there's going to be job loss, and a lot of people are not happy in retrospect, saying we knew you should have started doing something several months ago rather than waiting for inflation to get as out of control as we've witnessed. And just taking a look at the volatility in the market since he spoke, it has been off the freaking Richter scale. Major cap companies went positive during the Fed meeting as there was some signs of hope, only in the latter half of the meeting saying some very tumultuous things, leaving the market into this tyranny of downfall where we can see, like, I mean, take a look at this. VOO is down 2.3%. A lot of these mega cap companies like Meta is now down to $1.40 a share. But the purpose of this video is to see how the rich are handling the stock market crash and some of the strategies they're implementing that I've learned from my favorite YouTubers, whether it's Dumb Money, that recently discussed some things that I think are very relevant, along with Meek Kevin doing an interview with Ross Gerber, who manages like tens of millions of dollars in a publicly traded fund. They both are doing drastically different strategies that I find very intriguing. And if that's a conversation you can appreciate in return, I simply ask that you hit that like button, as we'll offer some commentary along the way. But let's start off with Dumb Money's recent live.
Something's wrong, because if you could accurately predict the macro market, even for any amount of time with any sort of reasonable accuracy, you should become a billionaire very quickly, right? Because there's infinite liquidity, infinite leverage. So I really don't believe anyone that says they're capable of timing macro markets. I know I can't. But Dave,
that's a phenomenal point, by the way. A lot of people keep trying to predict this market, where we're coming or going, but I don't see anybody out there that's actually making millions of dollars shorting or without doing some wicked, dangerous betting. And a lot of those people are getting devastated right now too, right? It's this kind of market where you just want to sit on your hands, do nothing, and just cost average. But we're going to hear some other interesting strategies in the interest raising environment that are really good investment ideas. But let's continue on and see what else they have to say.
I have been shorting or hedging my portfolio all year, and my short hedge has ranged between 30% and 80%. And I recently, in the last few weeks, moved it back up to 80%. Today, I want to say I'm up to almost 90% hedged today on my account. And that's simply by shorting the SPY, shorting the QQQ, and at times shorting a couple other ETFs that are more focused on consumer discretionary and retail. So it's not a.
Now that's probably, this again, very speculative here, because I'm curious to, how do you get 80% short hedged unless 80% of your entire portfolio is betting against the market? But the other crazy thing is just in generally, shorting consumer discretionary, which I've argued has been the staple of, a lot of people's investment portfolios during these tumultuous times, but it's led to overvalued stocks that are in consumer retail. I mean, we're talking about things like Pepsi, perhaps. There's a lot of other stocks that I think about when it comes to just kind of being a consumer staple, like even some of the utilities. They're all holding up far too well, and it's leading to much higher valuations. And there's kind of a discrepancy between tech stocks that are still growing at 10 to 20% versus some of these utilities and consumer discretionaries that aren't growing nearly as fast, but still trading at these wicked high 20 to 30 PE multiples. But still, what a wicked way to try and control the market, because inevitably you're going to have to take those shorts off the market, and there's no way to really tell, when the market's going to not go down, right? So I don't know. I never short the market.
A perfect hedge, but it pretty much hedges my portfolio more or less. And my gut instinct on when.
At no point this summer was I 80% hedged. I was probably closer to 20%, and it was, I wouldn't say it was trying to time the market. I would say it was more momentum based. As the market was going down, I would just kind of throw a partial hedge on, and when it looked like it was going back up, I would take that back off. And I did the math, and right now the market is down about 8% since the beginning of summer, when I did my whole sell in May and go away, which for perspective, that was what? We're back right where we were in March of 2021. So we've basically seen kind of undoing all these unrealized gains. But market's down 8%. My portfolio is down about 2.5% until today, where it looks like it's down another 2%. So I basically stayed even during a very volatile and down market, which is exactly what I wanted to do.
Now, I'm curious if he actually sold a lot of his positions and went away in May. And like you said, it sounds like he's been doing a little bit of hedging that's kind of been working out for him. Luckily, my portfolio, I think I'm still wildly outperforming the market, having a lot of exposure to Canadian stocks, which have been outperforming against the S&P 500. And I think I'm down about half as much as the S&P 500. I think on a total basis, it'd be somewhere around 12 to 15%, I'd say, whereas the market, I think, is down closer to 18 to 20%. But very intriguing.
Well, I every time I try to time the market based on just my gut instinct in a meaningful way, it usually goes bad. And that happened to me last week. Last week, even though I was already 70+% hedged, I decided to buy puts on the market because I just didn't believe this narrative that was popping up that inflation was going to settle anytime in the immediate future. Based on just what I was seeing, I was like, I think the market's wrong. But where I made my mistake is I bought puts that only lasted like 9 days. So my puts expired last Friday. I guess I put the trade on the 4th or something. And I lost $125,000 on those puts. And then the market this week took a dump. I would have made so much money if I would have just had those puts expired this Friday, today, as opposed to last Friday. And it's just kind of like the constant kick in the butt reminder that, Chris, you can't do that. You can't time it. Stop trying to do it. I'm so good not doing that. And then
Wow, what great advice here, folks. I think the jaded dividend investor is shining in this environment where if you're just a cost average investor into dividend stocks, ETFs, you don't care about the volatility and you're just buying for the dividend income. This is a true market definer for you because you're getting much better yields at much better prices rather than trying to play the momentum plays that dumb money so often chased after, which were these kind of, stock twits, Reddit type plays where they would chase the momentum that has now died, and it is impossible to find these kind of arbitrage, social arb trades that they chase after so reluctantly in a market like this, which clearly states that this strategy is best optimized in a bull market. Whereas in this market, even their shorts aren't really panning out that well. If you sold and went away, you would be doing fine, but then you got to figure out when to get back in. And if you're put optioning against your portfolio, you got to figure out when to sell. And even, the best multi-millionaire traders like these guys, they still can't do it successfully. So let's go listen to Ross Gerber and see what his strategies are in the midst of this.
It's just people's lack of confidence of Powell's ability to really assess what's coming in front of us. Because he's been such, behind the curve with everything that he's done over the last several years. So when you're thinking about what's actually happening in the bond market that I was trading today, I'm buying bonds that are yielding 4% out for a year from the U.S. Treasury, and I haven't seen that in a very long time. And what it does is it sucks money out of the stock market. And so for me, we have capital, we have lots of cash, and so if you can get 8.5% on a pretty decent set of corporate bonds or over 5% now tax-free in California municipal bonds, which implies a 10%.
So we're going to listen to GIC's bond rates. This is a strategy that I've been personally looking at implementing here in Canada because the highest rate that I can get on a guaranteed investment certificate from the government is around 4.2% over a year. And I mentioned to you guys that you should be staggering your basic emergency fund into a high interest savings account, which right now I'm able to yield 2.2% on. And if you got another 10 or 20 grand, divvy it up in 3, 6, and 12-month bond treasuries or GICs and have it so it's constantly turning over every 3 months. So you're getting access to that capital and locking in those absurdly high interest rates. We're living in a market that I've never experienced in several years. For the first time since 2008, people are actually talking about bonds and guaranteed investment certificates. And even the rich of the rich, the money manager out there, or the money managers are utilizing this as a tool instead of putting money in the stock market, because why buy a bank stock that yields 4% but is continually going down when I could just buy a bond, lock in a 4% gain with zero volatility? This is a new tool to the market that I think many of us younger investors are just starting to understand some of the strategies behind. Because again, you can lock that in for a 5-10 year rate and you are guaranteed that return at maturity. Again, presuming the government doesn't go bust or the corporate, bonds or whatever debt you're pulling from doesn't go broke. But let's continue on. This is fascinating.
what we call, taxable equivalent yield, if I can get 10% from the state of California, it's real hard to argue that stocks are as, beautiful as they used to be when you used to get nothing. You used to get nothing from these people. So now we're in an environment where people like me have a lot of incentive to increase our cash flow through buying these bonds, because during the Volcker era, one of the best things you could have done was just buy the bonds, and ride them for 30 years. And, when I started the business, there were bonds maturing from the Volcker era. And so it was like 80, 81, 82 rates were, let's say 15, 17, 18%. You got an 18% US Treasury bond guaranteed for 30 years. Like, think about.
Yeah, that's the crazy thing. During the 1980s, the Paul Volcker remarks are when he raised the interest rate up to like 15 or 20%, well above the inflation rate, to get things under control. But in doing so, that allowed individual citizens to actually get corporate debt for like 30 years at anywhere from a 15 to 20% interest rate. Forget stocks. We're not going back to that reality, but in Canada, I'd be happy if we can just get over 5%, anything over 5%, and these tools become very attractive to investors, which again, reflect into the values of real estate and stocks, as big money starts funneling it in to these bonds and this corporate debt, because it's such an easy way to cash flow guaranteed returns, and the higher it gets, the better it is, baby.
About the gift that Volcker gave people who had cash at the time to get guarantees. And so, I think really the market and me has little confidence that Powell will somehow like manufacture this ideal situation. And, my real estate friends say, there's no such thing as a soft landing. And there's a lot of truth to that.
Now, why treasury bonds if potentially you're paying more in opportunity cost in the event that you could, maybe pick up stocks at a discount or real estate at a discount?
Well, what we do is we buy them over time. So they mature. It's not like one bond for, let's say, $100,000. It's 10 bonds for $10,000 that mature each month. So then we can dollar cost average either back into the market or back into the bond market. But you buy a guaranteed bond, so as interest rates change, you don't lose money like you do in a fund or a mutual fund or ETF of bonds, where you lose money as rates go higher, even though your interest payment.
Yeah, that's the interesting thing. Bonds are a little bit more volatile because obviously if the interest rate goes up, people will not want the lower interest rated bond. There's some volatility. Some of them trade like stocks to some. It's not correlation like apples to oranges, or it's apples to oranges. I wouldn't say it's apples to apples comparison. But nonetheless, the strategy is utterly brilliant and something that I've been looking to implement, that I've talked about a few times on this channel, which is staggering your bonds and your GICs. So they're always maturing and you always have constant cash flow. If you're just sitting on cash, stacking cash, and you have a 3, 6, 12-month period, 2-year period where you're not really going to utilize that cash, or you're saving it for a deposit on a piece of real estate, this is your opportunity to start making real rated returns. Because again, the short-term GICs, the guaranteed investment certificates in Canada, I'm looking at are like anywhere from 3 to 3.5% on a 3 to 6 month investment, which is just crazy to me. And like, let's just continue on. We'll finish this up.
Payments go up. But if you buy a bond and hold it to maturity, you are guaranteed, as long as that issuer stays in business, or the government in this case, you're guaranteed to be paid off. So if I take 3.5% a couple days ago and now it's 3.7, it doesn't really matter. Even though it looks like there's a loss, it's going to mature in the next year or 7 months or whatever. So as the bonds mature, you buy stocks and you dollar cost average into the market, which is the best strategy you could have in the next 6 months, knowing all the volatility that Powell intends on creating.
This, again, is absolutely brilliant from a bunch of different metrics, because even if the market continues to be tumultuous or there's a black swan event, you can always keep every single month rolling over those bonds back into new bonds or new GICs. Beautiful, beautiful stuff here, folks. Now, from a personal prediction standpoint, guys, I really believe come into the latter half of this year, as soon as inflation starts to roll over, the Federal Reserve is going to become more accommodative. We'll start seeing the final petering of the interest raising environment to see how that bakes into, the GIC rates and the bond rates. So I'm being very careful about how I take on my GICs, because I'm always hesitant that if the interest rate goes up again, the next GIC that I'm going to be buying or the next bond will be paying a lot more. So you don't want to load all your money in at once either if that's the strategy that you're implementing. But again, guys, as I mentioned, I think inflation will start to roll off a hill, and the farther it starts to roll down, the faster it's going to roll off, and then we're going to be in a brand new market cycle that will not look like the experience we're having now. I think for the last few months, we've been in the eye of the hurricane. We're starting to come out the other side of it, and soon we're going to start seeing blue skies, but we got to finish up the tumultuous nature of what we're going through, which again doesn't resolve overnight. It's not like a band-aid we can just rip off. So I really look forward to seeing how this evolves. My strategy will not change, and I will update it obviously bi-weekly here on my channel, as I've done since the inception of this channel back in 2019. But let me know what you're doing, what you think about all of this in that comment section below, and I'd love to hear your strategy and some of the finicking things you're doing to maybe optimize your portfolio or take advantage of the volatility. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.